Hello everybody, it's Pam here from Niche. My New Year's resolution is to try to make the most comprehensive videos on the market. I'm not talking about these short 30-second videos. I'll do those. But if I'm going to talk about a subject on YouTube, I'm going to make sure it's detailed. And my goal for this video is to try to make the best debt consolidation, refinance, remortgage video with the most amount of information. I'm talking about information not just about what is debt consolidation. I'm talking about lending rules, affordability rules, different types of debts, what lenders like to see, what lenders don't like to see, why people get rejected on debt consolidation, why is it a risk area, what are the risks when you're dealing with this, what are the long-term problems around this, which lenders will do it, and what type of lending rules they put in place. Some lenders will see debt consolidation completely different from others. What happens if it's family members? What happens if it's for home improvements? So, in this world, there are lots of different solutions out there, but unfortunately, it's very difficult to give you this in 60-second video or a 500 word blog post. So my challenge to you is, I'm going to record this video. We're going to talk about it now. I'm going to give you all the information. If you find a better video, more comprehensive, or a blog post, put the link below out there and let's promote them because they actually deserve it. Debt consolidation obviously is a big subject. It's a high risk subject. As brokers, there's two subjects that are seen as very high risk, and some brokers actually will not take on debt consolidation mortgages. Okay, they won't do it, or their networks or their compliance people will not allow them to do this. Why is it high risk, and what are the high risk areas? Well, when I have to do my professional indemnity insurance, me and Richard, there's two questions they ask us. How many debt consolidation cases have you done? And how many interest-only mortgages have you done? Okay, because they seem to be high risk, because people that want to do these type of deals historically have had problems with lenders, with claims, with complaints, all sorts. Okay, so a lot of brokers actually don't do it or will stay away from this topic, and a lot of lenders have put restrictions in place, whether it's to do with the level of equity you've got, the amount of earnings you've got, or how much you can debt consolidate. Right, so that's that. There's my introduction to debt consolidation. Let's now talk about what is debt consolidation and what type of debts are debt. So you've got first charges and you've got second charges. So when you're dealing with secured loans or secured debt consolidation, these are generally done for remortgages, where it's a mortgage involved, which is a first charge, or a second charge, which is a second charge secured loan. They are secured on your property. Okay, so if you get repossessed, that's what happens. Okay, if you don't pay your loan or your mortgage, the disclaimer we've got on every video and every website and every email, as your home is secured on a mortgage, you could get repossessed if you do not keep up your mortgage payments. Well, that's what it is. Okay, the second bit is unsecured debts. Secured debts and unsecured debts. Unsecured debts are credit card bills, utility bills, sometimes mobile phones. I see a lot more mobile phone bills as well as loans for those iPhone whatever handsets. Okay, so I see a lot of that on credit cards. It could be car loans, okay, although they're secured maybe on your car, but they're still a personal loan, unsecured loan. Okay, so all sorts of loans and credit card bills, that's an unsecured. Now, what are the difference? Well, if you stop paying your credit card bill, because it's not secured on your house, it's highly unlikely you will get repossessed. Okay, they could put defaults against you, they could put county court judgments against you, potentially they could go down the, if it's huge sums of money, the bankruptcy route. Okay, but it's not a secured environment. Okay, so that's the difference. Okay, now that's where the risk comes in. So you got one aspect, clients coming to me and say, I've got all these credit cards and all these loans and I'm going to stick it on my remortgage. And then that's why the risk happens, because you're taking something which is unsecured, which essentially means you're not going to get repossessed if you don't pay it, and you're sticking it on a secured environment, which it's a totally different ball game. So clients need to understand that, and that's why the risk aspect comes into it. What you're doing is you're taking a loan. Let's say it's a 5-year loan and you're paying £700 a month. Okay, and let's say your mortgage is only £600 a month. So if you stick on a mortgage of a 4.5%, you're only paying another £200 maybe. Okay, so it sounds really good. I'm paying £770 a month right now, or £700. I'm going to stick this onto a mortgage. Great, sounds great. You're going to save yourself a load of money. Yes, but what you're doing is you're taking that, not only you're going to put that on a secured environment, but you're also chucking that down to a 25-year mortgage potentially. So you're taking a 5-year loan, sticking on a 25-year mortgage and paying all those years of interest, okay? So you're eventually going to be paying a lot more money. And you need to understand that. As soon as you put that on a mortgage environment, in most cases, now obviously everything's individual and this is for information purposes only, but you're chucking that across to a long-term mortgage. So it seems cheap now, but it could be a lot more expensive, right? And that's why the regulator, that's why the brokers or compliance officers in our compliance, they are very nervous around debt consolidation, and it needs to be done properly and carefully, right? So that's all great. We've explained that. Let's talk about some of the real life scenarios, okay? So I'm getting a lot of people doing extensions. It's too much for them to move homes and they want to do home improvements, extensions. Now, there's two kinds of category. There's the person that comes to you and says, I need to build an extension, I need some money. Or there's another batch of people that says, I have done an extension and you know what, I've paid for my new kitchen, new bathroom, my kitchen's got a loan on there, but my bathroom, I've got 10K on my credit card, I've got 30K on here, I've got 20K on there. So they've done the work, okay? If you're going to do the work, that's fine. That's not seen as debt consolidation because you haven't got the debt yet. It's actually a different mean, which is a different what's it called, a category, which is remortgage for home improvements. That's a little bit more better. But you're adding value. You haven't got a load of debt. You're adding value to the property. You've thought that out through. And also lenders treat that differently, and it's actually not seen as debt consolidation. So a lot less risk for clients, and pretty much all brokers and lenders will do remortgaging for home improvements, okay? Now, there are different levels on that, and I will probably have to do a video on remortgage for home improvements because some lenders want to see evidence of what you're doing, depending on what it is. You know, if it's an extension, it'd be nice to have planning permission maybe, or a quote from builders, how much money you need, and other lenders don't need to see that, okay? So we'll move that. When you come to debt consolidation, so you've got two categories. You've got the guys that have essentially they've got this debt, okay? And the lenders will look at it and go, right, okay, you've got this debt, this 60K worth of debt, okay? What's your income compared to debt? Now that's called the debt to income ratio rule, right? So what they want to know is, if you've got 60K worth of debt, what's your income? If you're on 40K income, then your debt to income ratio is much higher, okay? And typically the lenders, it's an unwritten rule by a lot of the lenders, but they don't like your debt to be higher than your income. Now, there are rules. Some lenders will go, your debt can't be more than 50% of your income. So there are rules around that, okay? Now, if it's a joint application and you've got debts of 30, 40K, maybe they're going to be okay, but it just depends on what your income profile is, right? So there's that. So debt to income rule, the harsh thing about the debt to income rule is, although you're going to clear this debt with a mortgage, so you're going to clear that 60K, the fact that you've got this debt and you have been able to borrow and you've been willing to borrow for that debt is enough for the lender to say no. And there are some major lenders in the UK right now, if you go to them with a high debt to income ratio, they'll just say no. And often that's not actually done at agreement in principle stage. So you go and write an agreement in principle, that gets accepted, goes to application, underwriter looks at it and goes, do you know what, you've got too much debt, I'm not happy with it, bang. That's it. You know, there's no, oh, let's have a discussion with you. No, your debt to income rule or the computer system, the credit scoring system will kick you out. Okay, so that's debt to income ratio. Then you got another level of debt rules for lenders. And the debt rule for lenders is lenders, I'll give you some examples. Lenders like Co-op, lenders like Santander, right? They've got a whole different way of looking at debt. They're not great lenders for debt consolidation generally, okay? And the reason for that is, let's say you go to them with 60K worth of debt or 30K worth of debt, and you're going to say, as part of the remortgage, I am going to remortgage this debt off. They go, all right, so how much is your monthly payments right now? Let's say it's, I don't know, £800 a month on your unsecured debt. They'll go, although you're going to pay that off, we essentially don't believe you, and we're going to take that £800 for your affordability, we're going to take that off for the mortgage. And then you turn around and say, well, hang on a minute, I'm going to pay that debt off. Why are you taking that into account? They go, no, sorry, we're still going to continue taking that for affordability. So whatever your income is, we're going to put down that you're going to have this debt for £800, even though you're not going to have this debt. Why are they doing that? Well, why they're doing it is because their own research, and this is what I've been told, their own research says a lot of people say they're going to do a lot of things and they don't actually clear their debt off. So they've got historical data, and they've had this rule for many years, okay? Which basically says people say to us that they're going to clear this and clear that and clear that. Once they've had the money, they don't clear it. And remember, these banks have got access to people's current accounts, so they can look at this stuff. They can look and go, okay, well, we did a mortgage for this guy here, said he was going to carry this debt, but why am I still seeing credit card payments going through on a monthly basis? There shouldn't be any credit card payments. So there are lenders around that. Now, there's another rule, and another rule is level of debt you've got. So I'll give you an example. Again, I'm picking on Santander. I don't mean to pick on them, but 50K, okay? So you can't debt consolidate more than 50K with them. And there are other, is it 30? It might be 30 or 50, sorry. I may not, don't quote me on this and don't get me in trouble. But there are other lenders that have got 30K, for example, debt. So if you go above that, they're not the right lender for you, okay? So you've got debt to income ratio rule. You've got affordability, whether they take it into account beyond the remortgage or not. And you've got the sums of money involved, okay? So there's that. Then you've got level of equity. Okay, when you're looking at debt consolidation, lenders will go, right, we'll allow you to remortgage, for example, for home improvements up to 90% loan to value. If it's debt consolidation, 75% loan to value. So which means if you've got a lot of equity in the property, it's not a problem. But if you want to go 80, 85%, and there are lenders that will do it, but a lot of lenders will cap that off. So there are rules around debt consolidation, specifically around loan to values of how much you can borrow compared to your property price. Okay, so that needs to be taken into account, because you don't want to go in as a remortgage and then they find out, oh, hang on a minute, there's debt consolidation here. And you can't, also you've got to be careful. You can't just say, oh, this is going to, if you say to them, no, I'm not debt consolidating, I'm going to keep these loans running. Now, we'll touch on affordability, but then affordability kicks in. If you say you're going to keep a £30,000 credit card debt running and you're not going to pay it off with a remortgage, then there are consequences around that. You think, okay, well, from a compliance perspective, it might be good. Pam, you've just told me that I'm better off not putting this on a mortgage or a secured environment. I'm just going to keep that running. I'm going to keep that personal loan running. Okay, tick box, compliance tick, Pam, done. However, the downside to that is affordability gets hammered. Okay, and I'll give you an example. Lenders, when it comes to credit card debt, will, although let's say you've got a 0% interest credit card for the next 12 months or 24 months, right? Doesn't matter for the lenders. They generally use a nominal rate to work out what that is. Now that could be 24%. So you've got 30K worth of debt at 24%, or they'll go 3% of the balance monthly, the balance they will use as the monthly payment. So what you do is £30,000. 3% of £30,000 is used for your monthly commitments on that credit card. Now, other lenders, you just put it into the calculator and they have a nominal credit card rate that they will use, 20%, 16%, whatever it is. But what I'm telling you is when you're dealing with mortgages, it's about your costs, okay? But it's also about your monthly commitments. Monthly commitments are massive. And I'm not talking about how many times you go to, you know, a restaurant or you know, those are they're in your control. It's your committed payments. So loans are committed, credit cards are committed payments, mobile phones are committed payments, student loans. People think student loans are not debts, loans. They are. When we work out affordability, we have to work out student loans. Okay, so student loans there's a little box that says, okay, clients on £65,000 a year, how much student loans can you see on their payslip? So we've got to put that in there. That's a loan commitment. That's a monthly commitment. Okay. The only caveat to that is majority of the lenders do not see pension contributions as a commitment. So you might be paying, you might be a civil servant paying £400 or £500 a month into your pension. That's not seen as a commitment by a lot of the lenders, which is great. Okay, because it encourages you to save for later. But all of this stuff is hammering affordability. And, I see a lot of car finance, right? PCP car finance. And that's hammering people because, they go, oh yeah, I want to get a remortgage. However, I've just got, £775 on my car finance a month. And we go, well, actually, that's a mortgage. You're going to get hammered around that. Okay. So then they have to think about, okay, well, do they really need this mortgage? Or what are they going to do with this commitment, existing commitment? Can they pay off the loan? Can they not pay off the loan? And brings me back to the next point. A lot of lenders will actually put a rule to say, they'll ask you the question, all right, you've got £20,000 credit card debt. Is this going to be paid before the mortgage is taken out or not? Will it be paid after the mortgage? And they will, as long as they can get a rationale of, you're going to pay this off, how you're going to pay this off. Is it going to be with the remortgage? Fine. Or you're going to pay it off yourself? Fine. Let's have a look to see if you've got the funds to pay off that 5k credit card. So those affordability rules are massive. I'm telling you, as soon as you start putting a couple of £100 a month for credit card bills, a couple of £100 a month for loans, maybe a student loan, maybe a car loan, maybe a mobile phone commitment, utilities, all of those things will have a massive difference on affordability. Okay. And when you're doing debt consolidation, affordability is going to be key. Obviously, you're trying to do this to make it more affordable and cheaper. And loan to values will have an impact on that. So, okay. So that's in regards to debt consolidation. In regards to how you go about doing this. So any broker or lender that does not thoroughly ask you about your commitments is not worth listening to or talking to. What I'm talking about is when you're filling in the forms later on during the application, not necessarily the inquiry form, you need to disclose the loan provider's name, potentially account details in terms of account number maybe, certainly start date, end date, current balance, will it be paid off or not? Because lenders will cross-reference this with the credit check they will do. Now, it's important that you run your own credit check beforehand so you know what lenders can see. But essentially, you're going to need all that information. It's no point filling in a form and saying, I've got 10k worth of credit card debts and it will be paid off. Because they need to match this stuff up. Okay? How many credit cards have you got? What's the conduct of it? And we'll talk about credit and actual credit profiles. So let's actually get to it. So credit profiles. So what the lenders want to see is obviously you paying that commitment off. Now, what happens is when one look at credit reports and signs of distress. Signs of distress are, one, please make sure you put your commitments into a direct debit. The amount of silly late payments and missed payments, and they're seen as the same thing by a lot of lenders, I see because people don't have it on direct debit, is honestly mind-boggling, right? Do not wing it. Do not think you're going to do it because you're going to miss one, okay? And missing one is actually quite important because let's just say if I missed a credit card payment last month and I want to go for a remortgage now, most lenders want to see 3 months bank statements. Most lenders will see missed direct debits or bounced direct debits, things like that. They see that and they'll see it on your credit check, okay? And that shows alarm bells, signs of distress. Oh, did they just miss it? Or, could they not afford it? They start asking questions. And a lot of lenders will go, if you've had any missed payments in the last 6 months, we will not do it. The high street guys. Some will say none in the last 3 months. So this is high street rules. So that little thing that you just forgot about, all of a sudden becomes a problem. So stick it on direct debit. It's the easiest way, it's the safest way, and then you can double check things, right? So we've got to the point where looking to refinance, and you've got all your information, you've got everything sorted out. Now, what happens with the lenders in regards to lending rules when they look at it? When an underwriter looks at it and they go, oh, this person wants to debt consolidate, they want to debt consolidate. They want to look and go, okay, well, I can see you were with this lender 2 years ago and you remortgaged to that lender. What was the reason for that remortgage? Because what they don't want to see is a trend of you debt consolidating 2 years ago and 2 years before that you debt consolidated. So you're essentially not paying off. You're not planning to pay off this debt. You're just raising money because your property happens to have gone up. Okay, so it's important to know that once you debt consolidate, there's a marker there, not just for the past, but for the future. Okay, so if you debt consolidated, if it was home improvement, if you did a remortgage 2 years ago for home improvement, and now you're doing debt consolidation, I think you'll be all right. But if you did a debt consolidation 2 years ago and you're coming back to do debt consolidation again, make sure you discuss that with your broker, because it's important that's positioned to the lender in the right way. What was the reason for that? Oh, I got ill and I had to do this and I had bills to pay. You know, it could be a life event, okay? So it's so important. And this is what I'm trying to say is, look, you can go online, type in Google debt consolidation. There'll be hundreds of broker websites and debt consolidate this and do this and free and easy and cheap and within 10 minutes, within 5, all of that stuff. But unless they're discussing this stuff with you, unless you now are armed with this information anyway, so you can ask the question, it's going to be pointless, because you're going to end up failing, or you're going to end up wasting a load of time around this. So lenders look at that. So underwriters will look at the situation, what your credit profile looks like, and let's talk about credit now. So yes, you can debt consolidate if you've got bad credits, or you've started defaulting or missed stuff. When it comes to late payments, missed payments, credit issues, it's all about when did this take place. The farther away from the type of time of remortgage, the better. 1 year, 2 year, 3 year, 4 year, 5 years, 6 year, last 6 months. Those are the rules. The longer, now, if you had a default and you haven't paid it off, not the end of the world, depends on when you had this. If you got a county court judgment, then it's all about when it took place. Is it settled? Is it not settled? Have you got a repayment plan? A lot of lenders will take it into affordability. Probably you got to go down the specialist lender route. The high street guys will not like defaults and CCJs and things like that, unless it's very, very minor stuff under £200 or something like that. There's a big difference between a mobile phone communication late payment and a more serious stuff, well, a mortgage, for example, a late payment. Okay, so there are lenders that have got specific rules. I think the sweet spot for a lot of lenders is 2 years or 3 years, and maybe 2 missed payments, 3 missed payments. There are rules around it. How many missed payments you've had in the last 12 months, how many you've had in the last 24 months, how many aggregated missed payments. So I've had 1 loan there, 1 credit card there, 1 utility bill there, 3 on my mail order, and I'm seeing that things to watch out. I'm seeing a lot of mail order, eBay, the sort of stuff, Kalala, those sort of things, the Temu things, all of those buy now, pay later, we'll split it into this, we'll split it into that. I'm seeing all sorts of transactions and late payments and stuff like that on people's credit cards, on credit reports, sorry. So watch out for that, okay? Like I said, stick it on direct debit, make sure it's paid off. Make sure you've got a plan to pay this stuff off, because it does come and bite you in the arse later, right? So that's really debt consolidation rules. You really need advice around this. You could try to do it yourself. There are lots of lenders that will do it. You can, do the Google thing, and there are lots of brokers out there that will offer this type of service. But these are some of the things, if you are looking to remortgage for debt consolidation purposes in 2025, you need to be aware of. So I hope you found this useful. I'm not going to go into rate specific. There is a broad range of high street lenders to specialist lenders, depending on what you want to do, depending on the discussion that we have. We could try to sort of, guide you and give you actual proper advice. As mentioned, these videos are for information purposes only. I'm not giving advice here. I'm just trying to help you guys out. If it's been helpful, my challenge still stands. If you find a better one out there that gives you more information, put the link and I will promote them. If not, all I ask for you is to promote me. Like, save, subscribe, I don't know, email it out on Facebook, WhatsApp to your friends. Let them know that there is an information website here trying to help people rather than just trying to get clicks. I'll catch you on the next one, hopefully soon. Now, another one maybe on home improvements in the next couple of days. Take care, all the best. The content of this video does not constitute giving advice. It's purely for information purposes. All cases should be discussed with a professional mortgage broker. As a mortgage is secured against your home or property, it could be repossessed if you do not keep up mortgage payments. Niche advice is authorized and regulated by the Financial Conduct Authority.